Hey, my name is Carter, and this is CoinCarter, where I share everything I know about money. Are you tired of feeling like you're drowning in credit card debt? You're not alone. Many people struggle with credit card debt, even kids like me, and it can be easy to fall into the trap of only making the minimum payment each month. According to the Federal Reserve, the average American household carries over $8,000 in credit card debt. However, by understanding the importance of paying off your credit card bills every month, you can take control of your finances and improve your credit score. I am here to help you do that. Your credit score is one of the most important numbers in your financial life. It's used by lenders, landlords, and even some employers to determine your creditworthiness. Your credit score is determined by a number of factors, including your payment history, credit utilization, and length of credit history. One of the biggest factors that goes into determining your credit score is your credit card usage. Your credit score can fall into a few different categories: excellent, good, fair, and bad. It's important to remember that everyone's financial and credit situation is different, and there's no magic number that may guarantee better loan rates and terms. So try not to be upset when you see other people getting higher loans, with lower credit scores. Generally speaking, credit scores between 580 and 669 are regarded as fair, 670 to 739 as good, 740 to 799 is very good, and 800 and above is exceptional. Higher credit scores indicate that you have previously exhibited responsible credit behavior, which may provide prospective creditors and lenders with more assurance when assessing a credit request. When it comes to issuing credit, different lenders have different requirements that may include details like your income or other aspects. This implies that, based on that criterion, the credit ratings they accept may change. The top 3 lender requirements include creditworthiness, income, and collateral. Let's take a closer look at those. One of the most important requirements for getting money from credit lenders is creditworthiness. This is a measure of an individual's ability to repay a loan or credit card debt. Lenders will typically review an individual's credit score, credit history, and income to determine their creditworthiness. A strong credit score and a positive credit history can increase the chances of getting approved for a loan or credit card. Another important requirement for getting money from credit lenders is income. Lenders will typically review an individual's income and employment status to determine their ability to repay the loan or credit card debt. A steady income and a stable employment history can increase the chances of getting approved for a loan or credit card. Lastly, some types of credit, such as a secured loan or a mortgage, may require the borrower to provide collateral. Collateral is an asset that the lender can seize, if the borrower defaults on the loan. Examples of collateral include a car or a house. The value of the collateral is usually equal or more than the value of the loan or credit. It's important to keep in mind that regulations might change based on the type of credit, the lender, and the goal of the loan. A minimum credit score, a minimum income, or a specified use for the loan, such as a mortgage for a home, are a few extra conditions that certain lenders may have. When you use a credit card, you're essentially borrowing money from the issuer. And just like any other loan, you're required to pay it back. But if you don't pay off your credit card balance in full every month, you'll be charged interest. The average credit card interest rate is around 16%. This means that if you have a balance of $8,000 and only make the minimum payment each month, it will take you over 20 years to pay off your debt, and you will end up paying more than $14,000 in interest. Missing a payment might hurt your credit score, because timely payments are the main element determining your credit score. If your credit is otherwise perfect, a payment that is more than 30 days overdue might lower your score by as much as 100 points. It won't harm your score as much if it's already low, but it will still cause harm. One of the most important steps in building credit is to establish a credit history. This can be done by getting a credit card, or a loan, and making sure to pay the minimum payments on time each month. Another way to establish a credit history is to get a secured credit card, which is backed by a deposit you make up front. This deposit acts as collateral for the credit card issuer and can help you get approved for a card, even if you have no credit history. Another important tip for building credit is to keep your credit card balances low. High credit card balances can indicate that you are overextended and may be a risk to lenders. Additionally, high balances can result in high credit utilization, which can negatively impact your credit score. To avoid this, try to keep your credit card balances below 30% of your credit limit. Another key to building credit is to pay your bills on time. Luckily my parents are paying my bills for me right now. Late payments can have a negative impact on your credit score and can indicate to lenders that you may not be responsible with credit. It is important to set up reminders for yourself to pay bills on time or to set up automatic payments to ensure that they are paid on time. Also, make sure to check your credit report regularly to ensure that all of your payments are being reported correctly and that there are no errors that may be impacting your credit score negatively. But occasionally, due to a job loss or other financial difficulties, it becomes impossible to make a payment on time. If you're in a bind, check into resources and contingency plans for when you can't cover all your obligations. By paying off your credit card balance in full every month, you'll avoid paying interest and be able to use your credit card to build your credit score. When you make your payments on time and keep your balances low, you'll see your credit score improve. A better credit score can mean better interest rates on loans, lower insurance premiums, and even more job opportunities. So, if you're tired of feeling like you're drowning in credit card debt, take control of your finances by paying off your credit card bills every month. It may take some effort in budgeting, but the benefits are well worth it. Remember, your credit score is a reflection of your financial habits, and by paying off your credit card bill every month, you're proving to lenders that you're responsible and creditworthy. By following these simple rules, you'll be on your way to a brighter financial future. That was a lot. I'm going to go nap now. If you enjoyed my video, please like and subscribe and leave a comment about any credit card questions you may have that were not mentioned in this video. And thanks for watching CoinCarter. It really means a lot to me. Bye! I hope to see you again.